Now, as we always start off, we look at, what is happening on a broad spectrum when we look at the different connections. And you can see that we've continued to move closer to where we were back in 2022. And that's what we've been saying, is that we're going to move along seasonal lines. It's just going to be at a rate slower than what we've seen in the past, but we're still going to see demand increase. It just naturally will, based on people doing more, people going out, but it's just going to be at, again, a slower rate. So last week we had an increase of, we had 14.58 million barrels a day of demand. This week we had 14.466. So you're still seeing some of those increases when you look at these four areas. So it's just a matter of, it'll continue to move up just because people are going to be doing more. You're going to have, spring break and movements. It's just when things start to slow down, one of the calls that we're making is that we're going to see summer demand underwhelm versus expectations, because we see the economic bite to the consumer really taking hold as we go through the into the summer. I was talking to my wife before, who was getting candy for my kids for Easter. And she said, she's like, boy, did the bag shrink. And it's funny but sad at the same time when you look at how these shifts are happening and how it continues to be fairly real when you look at some of these broader adjustments. So now when you look at distillate stocks, now breaking into its pieces, distillate had a small increase of 280,000 barrels a day, still 11 million below the 5-year, and a lot of that is still being driven by pad 1, which actually had a draw of 1.49 million, bringing us 8.3 million below the 5-year. So when you get an idea, it's mostly in the pad 1 side, but as we start to get out of that the heating season, not to say that we had a strong one, but as heating season ends and as you have that slowdown on the trucking side, we should start to see some of these builds escalate fairly quickly. And that's one of the key pieces when you look at refining, and why we talk so much about refiners and downstream, is that things can change quickly. We saw it with diesel and middle distillate and what's coming out of Russia, how that has kind of changed the landscape fairly quickly in Singapore as well as Fujairah. And I think that's an important piece, because this is where you're going to see it first on the downstream side as builds start to increase. And then as builds increase, then you have to think about, all right, well, what's happening to crack spreads? If crack spreads get weakened, at what point does the refiner say, you know what, operating at 93% doesn't make sense. 89% makes sense based on some of this math. And then that adjustment is going to reduce crude demand. And that's why we talk so much about the supply chain, and we try to hit it from multiple sides, from the upstream side, from the downstream side, and understanding what happens in between. So here, when we look at imports, we had a drop of 76,000 barrels a day. It's 110,000 below the 5-year, but again, it's just going to be a matter of some of this balancing act, because we are seeing exports remaining fairly elevated versus historics. But again, there's not all that much coming into the U.S. at this point in time. Excuse me. Now, when we look at diesel cracks, you can see how things have weakened, and they continue to kind of bounce back and forth. Depending on what metric you use, we're either at 42 or 33, depending on if what front month we're talking about. But you can see that it's coming under more and more pressure. And middle distillate and diesel cracks have really been the thing really supporting the underlying activity levels of refiners. And as this starts to weaken, it's going to be difficult. And that's when you're going to have to look at, okay, at what level of the middle distillate crack is the refiner losing money? And that's what is going to be that overhang when we start to look at underlying activity going through the remainder of the year. So then when we start looking at distillate fuel and pad 1, you can see that we've had these drawdowns, but we're coming to that kind of that precipice where you start to see that trough, and then you start to see those increases. And we're going to follow that seasonal move. The question's going to be on the back end, how fast do the builds happen? Is it going to be kind of that steady rate of change, which will just be in line with the 29-year average, just at a marked move lower? Or will we see more of a hockey stick where we'll go above that 29-year average? And that's going to really drive where those crack spreads are going and how that market looks, which is why we're going to talk so much about this as we go through really April into May and June, because that's when we're going to start to see, again, that a bigger drop in demand and where that where those storage levels are. And then when you look at pad 3, again, they're just kind of managing things at these levels, which we think they're going to continue to do between what goes into colonial, what goes abroad. But typically, as you get that big increase in activity levels coming out of pad 3, that's going to, again, create more distillate, which they're going to have to do something with, whether it goes into colonial or into the international world. And then distillate demand, as we've been saying, it's going to hang at the very low end of that cloud. We don't see that changing just based on the economics and what we're seeing in trucking. And as you can see here, trucking continues to be very underwhelming. And then when you use the freight waves data, which we'll talk more about tomorrow, which if you're not using it, it's fantastic. They do a great job of looking at it from multiple sides. There is a continuous slowdown to the point where now below 2019 levels, which is going to make things fairly difficult when you look at, again, that market demand structure. Then when you take it to the next level on the rail traffic side, total car loads are down just 0.2. But then when you look at intermodal is getting hit fairly hard when we're looking at the 13.9% decrease on the intermodal front, which again is some of the bigger issues that we're seeing and where we see some of those slowdowns in general. And that's, I think, going to be an important one to watch going forward, because if you're not on truck, you're on rail. And if you're not on truck or rail, well, it gives you an idea of kind of the health of the underlying economy, because we have to move stuff around. And that's why we talk so much about it. And as the consumer weakens, this is where you see that kind of real-time hit when you're looking at some of those diesel flows. Grains have started off at a slow pace, but that'll catch up as petroleum products continue to move about, and that's something that will also slow as chemicals as well. So we don't see a lot of upside when you're looking at some of these movements through both through both trucking as well as rail. So now when we turn it over to the shipping side as what is coming into the U.S., here's where we start to see some of these different shifts. So things are getting a little bit heavier into April, but we're already starting to see some of those numbers get pushed out to later in April, like instead of week 15, week 16, 17. And you're seeing that, and that's typically what happens is depending on timing. So when you look at some of the different levels here, you can see that versus last year, things are fairly on the low end. Then you start to get some of that pickup, but then that drops off again. So even when you go further up the supply chain, closer to China and other places of imports, you see that we're still continuing to see that slowdown, which again is going to keep trucking and rail at a depressed level. Now we do have another cold snap coming into the West Coast. I'm sure people have seen that there's another 2 to 4 feet of snow that's supposed to drop in California, and then things start to get a bit warmer. But when you look at the plains, essentially all the way to the East Coast, things are getting either near normal in New England or above normal as you go further south. And again, that's just going to put more pressure on heating oil demand, aka kind of coming to the end of heating oil demand, coming to the end of that natural gas consumption, which is why nat gas is where it currently is priced. So then when you look at gasoline stocks, you had a draw of 2.9 million. The 5-year, it's 11 million below the 5-year. And it's pretty broad as to where the shortfalls are. The shortfalls are really in pad 1 and pad 2, as all the other pads are actually fairly normal. So that's really where we're seeing some of those drivers. And again, pad 1 is driven by lack of imports. And as those imports remain low, that's going to keep that moving down. But then when you look at blending components fell 4.12 million. So again, it's going to balance out. So blending components is only 5.5 million below the 5-year average. But it's important to look at, where some of those mechanisms are, because when you look at the chart, you can see that typically this is where we kind of bottom and then start to go sideways a bit and then continue to see those draws as we go into driving season. And it's going to be important to see where do we sit versus this. And it's really going to come down to what is the activity of the average person given some of the stresses that they're seeing at the consumer level. Imports started to pick up. You had an increase of 401,000 barrels a day. That's 112,000 above the 5-year. But pad 1 is where, so we did get a sizable increase into pad 5. That's going to be some of that lumpiness. And as we look at in segment 3, we should actually see some increases on imports into pad 5, given the fact that there is a significant, and I'm talking a very significant amount of volume in Singapore, in Asia, that is going to have to find a home, and the U.S. is the place that's going to pay you the best. With pad 1, same thing. It's just going to be a matter of where are shipping rates, where's insurance, does it make sense, where's the ARB? So the ARB opened up a tiny bit, but again, it closed again. So that's why when you look at flows, it's going to be lumpy, but it's not going to be to the level that we need it to be to bring some of this movement in. Blending components, as you can see, moved back down. It's still in a comfortable spot where it'll likely start to flatten out. It's just going to be a matter of the chems market. The chems market continues to have an overhang, especially when you start looking at pricing, at demand, and it's just going to be a shift of, okay, well, does it go into the chem stream? Does it go into the gasoline stream? And just based on where gasoline pricing is versus chem pricing, it's going to make sense to go into the blending pool. This is just the one start. When you look at the Gas Buddy modeled, they're modeling at about, let's call it between 8.6, 8.7 million barrels a day of gasoline demand. As we said earlier in the month, things were going to be fairly slow and then start to increase as we get into spring break, Easter, and through April. And that's what you're seeing here, but you're still seeing it at a bit of a reduced rate versus what is normal for this time of year, which is something closer to 9.3, 9.4 million barrels a day. So again, still on the reduced end, but we're going to continue to see those increases, likely getting upwards to 8.8 million barrels a day as people take to the roads for their holiday. Then when you look at Asia Pacific, again, looking at TomTom data, a bit different type of information, you can see that Asia Pacific, obviously ex-China, continues to be sluggish. North America in general continues to underwhelm. And then Europe is starting to roll over as there's more protests, more slowdowns in general. So again, this is kind of painting the picture where things aren't dire. It's not like we're getting this big drop off. It's just we're 10% below normal. And again, that's when you look at the Gas Buddy data, when you look at the TomTom data, 10% below is kind of that new normal when you look at what activity looks like and why we continue to see some of these overhangs. Now, when we look at gasoline pricing and diesel pricing continues to normalize, and a lot of that is driven based on some of the storage levels getting better, not so much in the U.S., but in abroad. Crack spreads coming down, bringing down some of those pricing, especially as you have that slowdown on the diesel front, on the shipping front. But look at gasoline. Gasoline is flatlining, and that's the big issue when you start looking at some of the demand cycles. And there's two pieces to that. There's one where storage is still at a better spot for pricing, again, against kind of what we were saying. We thought things were going to be fairly flat because Europe was going to try to dump product. But again, the ARB, even in this scenario, it still didn't make sense based on the price of shipping. So you're seeing a lot of that product stuck in Europe, not coming across the Atlantic, which is keeping us a bit elevated. And now the problem is that is a big thing for inflation, for CPI, for what people feel. And we're already here, and we haven't gotten the full price increases that we're going to get for summer blend. Because remember, summer blend is more expensive than winter blend because you can't use butane the same way in the I'm sorry, not butane, benzene in winter, in summer blend, because of the carcinogenic nature, the fact that it kind of hangs in the atmosphere, and when you think about the gradients on the Reid vapor pressure ratios, you have to again move those things through, or the RVP ratios, if you will. You have to pass through the atmosphere easier, and that's why you get that shift from winter to summer. But summer just costs more to make because octane is more expensive in the summer than it is in the winter, and that isn't even fully priced in yet. And that's where you start looking at this kind of leveling off. There was a hope that you were going to see some of these prices fall, but now even as demand diminishes, you still have that replacement, which is why we see this kind of getting fixed right around these levels for the next few weeks. Now, when we start looking at the gasoline demand ratios, you can see that we've moved back to the highs. This is now the high of 2023, which makes sense. Like, we should be going higher, especially when you start looking at the levels for, again, as we've been saying, all of the different holidays starting to line up. But when you look at demand levels and even previous years, you get the spike and then the fade, and then you get that gradual move back up through May into obviously June. Then you're in your peak driving season with July, let's call it July 4th till about the first week of August as the 5 to 6 week core driving season. And what we're saying is that we're just going to be at a reduced level. And I think it's similar back to what TomTom showed, what Gas Buddy showed, is about 10% below normal. And I think that's something that could possibly get worse depending on where rates are, what credit card delinquencies look like, how people feel about the situation. Because I know when my wife was looking at some different vacations, I mean, prices for hotels, restaurants, you factor in all these pieces, it's more expensive to go away today than it was last year or the year before that. And that's going to eat into some of these individuals that may want to have staycations. And I think that is going to become more prolific, which again will reduce some of these numbers. Now we look at propane. Propylene had a drop of 2.46 million, but when you look at it, it's still moving where it should be but at a much slower pace, which is again going to weigh on underlying pricing, which is something we're going to talk about more, in the FSC show and in our insights. Now, when you look at jet fuel had a build of 1.41 million, just some of that balancing act. And you can see that demand fell along seasonal lines. Again, it's just the seasonality of when does that, they pull it in, airlines will pull it in ahead of that push, then it'll drop back down. So they're just going to be managing these different pieces. And again, that's something where we'll see some of those increases in general. Jet fuel demand, again, nowhere near pre-COVID days. And this is the piece that we've been talking about. So there's lagging international travel, which, again, when you think about the cost, is likely going to persist. But you do have that rising fuel efficiency, and then you have airlines trying to maximize how many bodies are in one single plane instead of adding back those flights, which is, again, keeping us a bit more reduced. The 12-week ahead passenger departure schedule for the 12 weeks ahead is set to increase by 17.6%. And again, that 17.6% is normal because if you think 12 weeks ahead of March 21st, you're in summer. That's when, again, that peak vacation period. And when you look at it, it's essentially unchanged versus the previous week. But then when you look at Europe, they're starting to cancel some flights because of the protests, because of the issues. So we're still a bit below where we should be, which is something that is, I think, going to be persistent. Now, when you start looking at TSA checkpoints, again, the U.S. is fairly normal. We see that being consistent, where the Euro area continues to underwhelm and be about 10% below normal. And then when you look at this against just previous years, things are fairly stable. So then when we start looking at some of the other pieces, we want to go abroad and we want to start looking at what is happening in other areas. The open table data is being updated, so I don't have access to it until they're done with their maintenance. But in the next segment, we're going to go deeper into what is happening in the international markets. How is Russian diesel adjusting that? Because I think that's the biggest piece of the puzzle that the market may be missing and maybe not understanding to the same degree.